Good afternoon, everyone that's joined us today for our live webinar. I'm Sonia Clark from First Pathway Partners in South Africa. I'm the regional manager, and I'm very glad to introduce our guests from Sable International. Today, a discussion topic is taking stock of the RAND and the SA exchange control. How did we get here and where to now? Very, very important topics. A brief look at the RAND, the perfect storm that has put us on the back foot. More recently, why other global risks are driving RAND volatility and the South African offshore trends in an increasingly volatile world. Let me tell you a little bit about First Pathway Partners. We are one of the biggest regional centers based in Milwaukee. We were one of the first regional centers to open out of 200. And we do have a success rate of 100%. We vet our projects very carefully, and that is thanks to our CEO, Mr. Bob Kraft. He's a thought leader and well-respected in the highest places in the United States administration and on a federal level. Bob Kraft also heads up II-USA, which is Invest in the USA. You're welcome to go on their website to learn a bit more. And first of all, I'd just like to introduce you to Andrew Rissick. He's the Director of Forex and International Projects from Sable International. I'm going to read out a bit about Andrew and also Andrew's motto. And after that, I'll introduce you to Mike Abbott. He's the Director of Sable Wealth. So a bit about Andrew. Andrew, obviously being the Managing Director, is originally from South Africa, where he was schooled at Michael House and then completed his degree in economics at the University of Stellenbosch. He served as an officer in the South African Navy before completing his management training with Anglo-American subsidiary McCarthy Group. He then relocated to the UK operation in 1994. After this, he was involved in several private equity deals with the UK and South African investors, before returning to South Africa in 2004, now based in Cape Town. He established a company that facilitated the investment of UK client funds to the emerging South African property market and successfully sold his interests in 2011 before appointed as heading up Sable's group global Forex business and more recently their South African investment migration business. Andrew's motto: nothing so conclusively proves a man's ability to lead others as what he does from day to day to lead himself. Over to you, Andrew.
Sonia, thank you very much. Hello to all the invisible listeners. I'd firstly like to just thank Sonia and First Pathways Partners very much for the opportunity to actually be a guest on this webinar today. And hopefully all of you will find it really informative. Thanks for the introduction. So I'm not going to spend any more time on who I am. I'll just talk a little bit about Sable International and who we are as a business. I'll give you a very high level introduction for those of you who don't know anything about the business. So Sable International started off in a slightly different guise in 1995, headquartered in London. It used to be known as First Contact. And that business was set up just after the 1994 readmission of South Africa back into the Commonwealth. After the first democratic elections in 94, there was a sudden influx of South Africans who could go legally and go and live and work in the UK. And our business was seated looking after the needs of those people. And as time has progressed, so those client needs changed and their needs became more complex. And a lot of them actually became established in the UK. And they started setting up their own businesses, purchasing properties, and they needed a lot more complex support. So we moved away from just being a company that helped people get visas and do their sort of tax returns to a company that started dealing much more intrinsically with their wealth management and other offshore needs. So the business has got four core services that I think are very relevant to people who are looking to invest cross-border anywhere in the world, but we aim particularly at South Africans and sub-Saharan Africans who are looking to invest abroad. So we focus on tax and offshore structuring. We've got a big foreign exchange business. We have an international wealth management business. Mike Abbott, my colleague who will be speaking today as well, he heads up that business. And then we've got accounting and tax capabilities in all the jurisdictions that we operate. And then we've got a residency and immigration business. So that's dealing with people, who are looking for work permits, people looking to get residency or citizenship in countries through investment or through different skill sets, etc. So a very broad range. And those services that we provide are in the sort of jurisdictions of the UK, Europe, USA, and Australia. We do a little bit of work in South Africa, but our core business is looking outwards into what I would probably call the developed world. In 2015, we made a decision to focus our business. We had 3 or 4 different businesses under different brands. And in 2015, we made a decision that every business would operate under one brand, and Sable Group then became known as Sable International. And we also made another strategic move where we really focused on looking after South Africans who don't necessarily want to leave South Africa, but they have got needs to invest offshore. As you all know, in 2010, there was a big relaxation in exchange control in South Africa, where people nowadays can actually take quite a lot of money offshore, and it's a very important part of people's investment strategy. So that is really how we as a group have positioned ourselves. And we believe in an international world that international citizens need sound advice, both in their home countries and in the jurisdictions in which they invest. And it's very difficult to find people who have got those skill sets on both sides of that border, from where and to where they're investing. So that's just a little bit about Sable. So Sonia, before we climb into the subject, back to you.
Right, thank you so much for that introduction. If I can hand over to Mike Abbott, the Director, Sable Wealth. He does investments and markets in the time of, speaking about investments and markets in the time of COVID, and future discussion on higher level structures and tax, which we can touch on. It's a little bit about Mike. So Mike is the Director, Sable Wealth, as I said, and he's also originally from South Africa and was educated also in South Africa, after which he began his career at Investec Private Bank. In 2006, Mike founded the Property and Lending Advice Division of Sable International, and he runs the business as head of the Investments Committee in the UK. Over to you, Mike.
Hi, Sonia. Thanks again for having us on the webinar. It's really nice to be here, and hello to all the listeners. Just a quick summary as to what I do on the Sable Wealth side. We are a financial planning firm, financial advice firm, but we are a cross-border specialist. So what we've got advice licenses, investment consulting, and paraplanning, financial planning licenses in the UK, in South Africa, in the US, and in Europe. And what we do primarily is we do financial planning and investment consulting for clients who are living somewhere where their assets are not, or are migrating across borders and therefore have assets moving across those borders. So that type of financial planning and investment work requires a fairly in-depth understanding of tax treaties, residency and domicile rules in different jurisdictions, and how those domicile tax and residency rules affect structures like corporates and trusts, and also how those different rule sets affect the underlying investment strategies that are run inside structures. So we build our own investment solutions that we manage for clients, and we do a lot of this sort of more tax-led type financial planning work. And that's a quick summary from us. I'll hand over back to you, Sonia.
Thank you so much, Mike. And if I can ask Andrew just to speak a bit about property investment trends, also exchange control regulations, and the RAND predictions. Hard topic. Over to you, Andrew.
Thanks, Sonia. Okay, well, look, what I'm going to do is I'm just going to start off and I'm going to speak a little bit about the RAND. Because obviously, if you're investing offshore, the RAND, if you're moving funds out of SA or you've made your money here and you're sending it offshore to invest, that has a substantial impact on the ultimate return of your investment. So it's quite important to understand what drives the value of the RAND, and how that's going to affect the long-term value of your investment. And then also, more importantly, to understand how much money one can take out of the country. So as I mentioned earlier, in the old days, pre-94, we had a very strict exchange control framework. It was really difficult. In fact, it was impossible to move substantial capital privately offshore, although amazingly, so many people managed to get a lot of cash out of the country. Most of it was illegal or grey money. But since 2010, there's been massive relaxations in South African exchange control. And I think that the current government realized that being part of a global world, we needed to level the playing field for South African investors to be able to invest offshore, and equally to attract foreign investors to come into South Africa and invest, whether it be privately or commercially, and to get a free flow of funds crossing the border. So what we currently have available to us as South African residents is we've got 2 allowances per annum, and that's per calendar year. You've got the 1 million Rand single discretionary allowance, which is available to all South African taxpayers. And essentially that money can be used for discretionary purposes. So for instance, if you've got a daughter who's getting married in the UK, you would use that allowance to pay for the wedding. If you've got any children overseas studying, again, that would come out of that discretionary allowance. But you can also use that allowance for investment purposes. Then for people who wanted to make substantial offshore investments, we have the foreign investment allowance, which is currently 10 million Rand per taxpayer per calendar year. So that's quite a lot of money. Although I suppose if you convert it to a lot of the hard currencies, it doesn't get you very far over there. But from a South African perspective, that is a per annum allowance. So if you can take 10 million Rand a year out of the country, I think you'll probably agree with me that for all intents and purposes, exchange control from a capital flow point of view has been heavily relaxed. So in order to move that 10 million Rand, one requires what's known as a foreign tax clearance certificate from SARS. So the Reserve Bank just want to know before you move that pre-approved allowance of money out of the country that your tax affairs are in order. And they do that by checking that you've got a clearance certificate from SARS. The other thing as well, it takes probably, we say, between sort of 7 and 10 working days for us to help you get that certificate, provided your tax affairs are in order. And we just need to prove the source of funds for those particular funds that you're looking to divest from South Africa and invest offshore. So just a little bit about us as a business. We're obviously authorized and regulated in South Africa. We authorized by the Reserve Bank to carry out these transactions on your behalf. We're also regulated by the FSCA, which is the Financial Services Conduct Authority, and we also registered with FIC. So we authorized to perform FICA on all of our clients. Just to give you an idea, in 2019, we transferred in excess of 7 billion Rand just for private investment for people looking to invest into real estate and share portfolios offshore last year. And then the other thing that's also worth mentioning is that we can also help clients with hedging strategies. So for instance, if you know that you need to buy a property overseas and you want to take advantage of the rate today, but you only may need to make a payment for the property in 3 or 4 months, we can actually do a forward contract and lock in a rate for you if the rate is favorable today. You don't need to wait. So that's slightly more technical, and we can help people manage their currency risk when investing offshore. I can't sort of show anyone a chart on this particular webinar, but if you look at how the Rand has performed over the last sort of period of 10 to 15 years against a basket of hard currencies, you know, it'll devalue on average between sort of 7 and 8%. So let's just take it against the US dollar for sake of an example. If you look at the long-term trend line, the Rand devalues between 7 and 8% per annum against the dollar. But along the way, we see some pretty volatile blowouts. And a lot of you may remember in 2015, when Jacob Zuma fired Nhlanhla Nene, who was our finance minister at the time. That was the last a big blowout before the COVID crisis, where the dollar hit just over 16 to a dollar. Before that, we had a real blowout in the 2008 global credit crisis. And then the one that's now sort of getting into the distant memory is 9/11 in September 2001. The Rand also took a big hit when that event happened. And more recently, we've seen a substantial devaluation. In fact, this first quarter of 2020 has definitely been the worst in the history of the Rand. We've seen around about a 32% devaluation in the currency since January. And I think that's very topical at the moment. We're all locked down and we're on this webinar because of this little virus. That's had a massively negative effect on the Rand. But what happens is it's important to try and understand the factors that drive the Rand. So in all of those different crises that I've mentioned, there are effects that are external to South Africa that have an impact on the Rand. And then there are also internal effects that impact the Rand. And often what happens is you'll get negative external and negative internal factors that create almost a perfect storm, and then you'll get the sudden devaluation. And when it devalues, it's typical human nature. People panic, people start selling, that accelerates the devaluation, and you start seeing this massive devaluation and a big spike in the trend. And what happens suddenly is the Rand becomes very undervalued, which makes South African assets very cheap for offshore investors and for speculators who are speculating on the currency. And what happens is you'll slowly start seeing people starting to buy the Rand again to take advantage of those deals, and it starts to return back towards its long-term trend line. And so that is essentially what happens. It is the nature of markets. It's fear, it's greed, and all the different emotions that drive how markets react and how these markets affect the price and value of commodities, of which the Rand as a currency is essentially the value of the Rand is driven by the demand on the actual currency. So some of the factors one needs to be aware of is and understand is that South Africa is an emerging market. So just let's talk about the current crisis with this coronavirus. We are seen as a high-risk emerging market like Brazil, Turkey, Indonesia. The first thing that happens when there's a global crisis is everybody sells out of emerging markets and they run into what is seen as safe haven currencies like the US dollar, the British pound, the euro, Swiss franc, etc. So we've seen a lot of negativity, which has been Rand negative very recently. We also need to understand that South Africa, from an inflationary perspective, we run a much higher inflation rate than a lot of our trading partners. So if you look at the USA, Europe, the UK, they really are sort of running at probably 1.5% inflation, whereas South Africa will be running at sort of 6, 7, 8%. And in order for us to stay competitive with our trading partners, the Rand does need to keep adjusting to keep us competitive globally so that our products don't become too expensive with inflationary pressure every year. So the Rand devaluation takes into account and makes sure that we remain competitive globally. So labor productivity is a big issue and has a big impact on the Rand. Also, in the last few years, we all know it's been very well documented, the South African economy has experienced very, very low, sub 1% per year GDP growth. And let's not try and talk about the COVID effect. I mean, that's because that is not only a South African story, that's a global issue. But leading up to this COVID crisis, the South African economy has really been in trouble, and that has been pretty Rand negative. One of the things that does drive Rand value is our relative interest rates. South African government bonds deliver really good yields compared to a lot of the more sort of first world bonds. If you look at South African bonds, probably around 8.7 up to about 9.7% versus the US government bonds, which are probably yielding about, sub 2%. So that differential makes it very attractive for a lot of foreign funds to put funds into the South African market, looking for a better yield. And then they'll balance that yield against the perceived currency risk. The other thing as well, South Africa runs a double deficit. We typically run a trade deficit, and we also have a fiscal deficit. So our government is spending more money than it collects, and we also import more than we export. So that means that we need more foreign currency than we need rand, which puts negative pressure on the value of the rand. I'm not going to talk about local political issues. We're all very sensitive to that, and that's probably why we're all sitting on this webinar at the moment. But local politics has a huge effect, particularly on the short-term volatility effect on the rand. And then international issues, we've seen this standoff that seems to be getting more and more pertinent between China and the US. That does have an effect on the rand. It creates a lot of uncertainty globally, which again is not good for us as an emerging market. But more importantly, the slowdown in China is also negative on the rand because we're a country that exports commodities. So we're a very commodity-rich country, and as the global economy slows down, China produces less, so that reduces the demand on commodities from South Africa, again, being quite rand negative. So I think you'll agree there are a lot of very negative factors that have driven this big devaluation to where we're sitting at today. And just to give you an idea, as we sit now, we're sitting at about 18 Rand 70 to a US dollar, which is not quite the worst it's been because we touched 19 recently. It's sitting at 20 Rand 46 to a euro and 23 Rand 25 to a British pound. So pretty gloomy, but we do think that there's going to be a comeback. The rand is currently extremely undervalued. But the other thing that we can also touch on maybe when we talk in the question and answer time is also this effect of the ratings agencies and these recent downgrades that we've had. But hopefully that'll just give you an indication of things that you need to understand affect the rand. So what's really important is to understand when you're making an offshore investment, to get your timing right is quite critical, because what you don't want to be doing is to be taking your currency out of South Africa when you're sitting at the kind of rates that we're seeing today. So if you're about to buy a property in the United States for $900,000 US, the last thing you want to be doing is buying them at 19 Rand to a dollar. So make sure that you plan your currency purchases over a period of time before you need to make the investment. And in order to do that, you need to allow yourself a bit of lead time, and you also need to make sure that all your tax affairs are in order and your ducks are in a row so that you can move the money on time for when you make that investment. So just a lot of things to think about. And yeah, I'm obviously going to be available for a while to speak to you guys specifically about questions that you have. But before I do that, just very quickly, why would somebody use a company like Sable to handle their foreign exchange as opposed to using their bank? And quite simply, it really comes down to two things. It comes down to the service that we provide. We've got 20 brokers sitting in our office in Cape Town. That's what they do all day. We do thousands of transactions a month, and we really do pride ourselves on exceptional personal service. And most importantly, we give you really competitive bank-beating exchange rates. So that's just a little bit about us and a little bit about the rand. And back to you, Sonia.
Thank you so much. I think that has given us a lot more information that we get on the mainstream media. So very, very, very good for us, I think, in terms of looking at our products in the US and also helping our clients, to make a more sound and informed decision, and basically at the end of the day, consulting with experts in the field competitively. So they get the correct answers and, the assistance in setting up certain structures. Before I get onto the questions and answers with Andrew, I just want to hand over to Mike just to see if you've got anything more to say on investments and markets in the time of COVID, and secondly, future decisions on high-level structures and tax, or would you like us to move straight into the questions section?
No, Sonia, happy to give a quick pricey of the situation we're seeing at the moment. Obviously, the drawdown in financial markets has kept us very busy, trying to understand the effects in our portfolios and trying to actually deconstruct what's happening. And there's obviously a broader index number that everyone's aware of. You know, the S&P 500, the FTSE 100 numbers. We've all seen those indexes draw down and then pull back somewhat. But within that headline number, there's a much more interesting story, which is the greatest degree of dispersion between the winning and losing sectors that we've ever seen in history. But what does this mean for people who are considering migrating and moving to a different country or investing abroad in order to create the opportunity to move at a later point? I think the message we are sending to clients is about preparedness. The decisions around crossing borders and moving wealth across borders usually involve some thinking across not only asset classes and currencies, but also around tax, and within tax, it's income tax, estate duty, and capital gains tax. So our advice to clients is to step into the advice space quicker, sooner in the process, start having the conversations, trying to understand what the landscape is that you're needing to deal with in terms of South Africa versus the country you might be looking to move to or get a residency solution in, and so that we can understand the tax elements. So that gives us the ability to be on the front foot around managing the timing issues of asset purchases, because there are inevitably some timing issues, and often it's better to try and smooth out price points, but you can only do that if you're forewarned and you've got time. So that would be my précis of the situation. Back to you, Sonia.
Right, thank you very much. I think I'm going to just skip to some questions with you, Mike, and then I'm going to go back to Andrew while we're on topic. One of the questions is, what are the key tax issues migrants to the US need to plan for?
The US has got one of the more complicated personal tax codes in the world. So that's worth knowing up front. It's not a simple tax jurisdiction at all. And one of the reasons that makes it difficult is because the US taxes foreign residents who hold citizenship or green cards in a way that's pretty unusual around the world. So what it means is that the US has a method that punitively taxes non-US investments. So what this means is that if you become a US citizen before arriving in the US and you hold non-US investments, and what I'm talking about are, for example, personal pensions, provident funds, retirement annuities in unit trust accounts, offshore trusts, all of that becomes very relevant when your jurisdiction of choice to move to is the US. So the situation we try to avoid with clients, and that's why we encourage clients to contact us early in the process. What we try to avoid is a situation where someone moves across to the US, retains assets for a couple of years, speaks only to a US tax advisor, and the tax problems arise in year 3, 4, or 5 of having now living in the US. And how those tax problems often arise is when you start selling some of your foreign assets and you get this really punitive tax treatment of these offshore assets. So the good news is these things can be restructured to fall into line with and be compliant with US rules. 10 years ago, the kinds of solutions we needed to do that were quite few and far between, but they've actually grown enormously over the last, particularly 5 years. So there are solutions in place. One of the reasons we went and got a US advice license was to be able to access that full range of options, both in terms of solutions, investment products and solutions both within the US and the solutions that are compliant with the US that sit outside. So it is a jurisdiction that requires a lot more advice than most, and a bit of forward planning, because sometimes you have to restructure the assets before you even head to the US. And I'll make a particular point on one structure, which is the family trust, the offshore family trust or the South African family trust. When the protector or the settlor of a family trust, be it South African or offshore, moves to the US, that can trigger some very unintended consequences in terms of how the assets within the trust are taxed. So anyone who's got children who are beneficiaries of a family trust that are heading to the US or already in the US, or the settlers are thinking of moving to the US, they really should get advice up front before the move is made. Over to you,
Right.
Sonia.
Thank you. Yes, those are questions we get all the time. We are a regional centre, and that's why it's good to actually have the advice that we do have from you for clients, and we can work very well together, I think, because so many questions that are posed to us, here in South Africa is a very difficult one to answer. So anybody with those questions, please feel free to contact me, and I'll put you in touch with Mike Abbott. So just on that note, there is a red tab on the right-hand side of your screen. If you tap on that, you'll see a menu comes up and a chat button. So if you do have any questions, please feel free to send us your questions. And in saying that, I'm moving on to the next thing, which is I've heard it's difficult for South Africans to access good offshore investments. What's the best way to invest offshore, Mike?
The issue that South Africans have is that the regulations in South Africa are designed to ensure that South Africans can only invest in a limited list of offshore funds that are approved in South Africa. So obviously there's a massive universe of offshore funds and stocks and shares and bonds, but those rules encourage and force South Africans to stick to a very limited range of trusts run by the big asset managers in South Africa. That's a very protectionist type regulatory system. So in order to offer the full offshore universe of solutions, what you have to do, what we've done, which took us quite a bit of time to set up, which is to have dual licenses, to have licenses in an offshore jurisdiction as well as in South Africa, and then use the dual licensing position to offer a more complete set of solutions. So I think, what should South Africans looking to invest offshore be aware of? The first thing is that you're looking at a very limited universe of opportunities. And if one's choice is to build a portfolio of stocks, a short list of the top blue chip or tech stocks globally, obviously that's easy enough to do on an offshore platform. The one thing you've got to be aware of is the CITES issues. So wherever those stocks are listed, you would have potential inheritance tax charges applicable to that jurisdiction. So for example, in the US, if you chose Google, Apple, Netflix as some of your stocks of choice, then you would have, for every amount over $60,000, you would potentially be owing inheritance tax to the IRS in the US if something happened to you. So those unintended or unknown tax issues around the more simple solutions are often the pieces we address when we set up a more structured solution for a client.
Fantastic. Should someone moving abroad actually move their finances, meaning financially immigrate?
The question as to whether you should financially immigrate depends a little bit on the individual. Financial immigration is a reserve bank status, and if your intention is to become tax resident in a different jurisdiction, but you're still spending a lot of time in South Africa, then financial immigration may be one of the factors that points towards you having moved your tax residency, but it's not definitive on its own. So it's important for people to remember that there are two tests for South African tax residency, one of which is the ordinary residence test, which looks at if South Africa is the place to which you return from your wanderings, then you are a South African tax resident. The other one is the physical presence test, the number of days you're spending in South Africa every year and over a period of 5 years. And then there's a third way that one can become non-tax resident in South Africa, and that is if you acquire a tax residency in another country and there is a double tax treaty between the two, and the double tax treaty tie breaks you to the other country. So this has become very topical since the Section 10 changes to the Tax Act, where South Africa is looking to tax offshore earnings for expats abroad. And in most cases, financial immigration is not actually needed, the circumstances of that individual suggest that their tax residency is already abroad, or their tax residency is so definitively in South Africa that even financial immigration is not really going to change that. So it's something they should get case by case advice on. But the other thing to remember is in March 2021, financial immigration as a concept will fall away. And the test, we understand the rules have not been finalized, but the test will become your tax residency. So what we're expecting is an influx of clients needing advice on where their tax residency is based on their individual circumstances. And that advice will then be what they rely on for the treatment of how they file tax in one country or the other. Over to you, Sonia.
Sonia disappeared.
I think we might have lost Sonia.
Okay. Yeah, Sonia's disappeared. Maybe what we should do while Sonia is probably trying to log on again is to see if there are any questions from any of the guests on the webinar. There is a way, I'm not a webinar expert, but there is a way of asking us questions. Mike?
So yeah, Andy, I've got a question here. There was based on the discussions before the webinar. There's one or two questions here that maybe I'll fire one at you. When South Africans are sending funds offshore, do you see any trends on the real estate side that are relevant for clients to consider when choosing destinations?
Yes, it's quite interesting. I mean, obviously, running a foreign exchange brokerage like ourselves, we do get to see, you know, where funds are coming from and where funds are going to. And I think that most South Africans who are looking to buy offshore property are looking in what pre-COVID was sort of deemed to be relatively stable economies. So places like the US, very popular, UK, very popular with South African investors. Australia, not so much anymore. It's not that attractive for foreign investors to invest in Australia. The government tries to actually discourage foreign investment into real estate. Europe, places like Berlin, we've seen a lot of clients investing there. But an interesting trend in the last few years has been clients investing specifically into areas where they're getting a good real estate investment, but they get the added bonus on the back of it of getting either a second residency or a second citizenship. For instance, the USA EB5, which most of the passive investments like First Pathway is, it's an underlying real estate investment. Countries like Malta, if you invest in real estate there, there's obviously quite a big donation to the government. But that's definitely been a big trend in the last 2 or 3 years. We've seen, I think, an explosion in that. And that's driven by people looking for either a plan B or to physically actually immigrate from South Africa.
Right, I'm back, guys. Apologies.
Yes, welcome back.
The Wi-Fi, yes, in South Africa. Thank you very much. Can I carry on where I left off, Mike?
Sure.
Right. What I wanted to ask you, what the benefits of investing offshore would be before I actually migrate. What would that be?
Correct. So I've been someone who believes South Africans should have been investing offshore for many, many years, going way back. Now, this is because of a concept called home bias, which is it's a reality. We see this everywhere in the world. We see all populations around the world invest more in their home countries than they do abroad. So that's a fact, and we understand why people invest in their home countries for some degree of liability matching. So it's better to invest in assets that generate income in the currency you're going to be spending in. So that's sensible. And home bias also means people tend to buy assets that are more familiar to them, that they understand better and that are closer to them. But in in certain countries, home bias really works against you, and South Africa is one of those. So South Africa had a commodity-based bull run or boom over quite a long period of time, which ended before 2008 and has never recovered. So because South Africa's currency is very well matched with global volatility, there's a problematic double whammy effect that South African investors have, in that when the world goes risk off, so there is a move away from risk assets towards safe assets, South Africa is one of the markets that investment managers around the world will sell. So South Africans' investments, they see not only their currency devaluing at the time the world goes into risk off mode, but the investments that they hold in that currency also devalue in that home currency. So there's an FX effect and there's an asset value effect. So for South Africans, it's always been structurally better to hold more offshore assets. And that's become more and more true as time's gone on. And we can now see that on a risk-adjusted, a tax-adjusted, and a foreign exchange adjusted basis, South Africans have been paying a real penalty for holding South African assets for in excess of 10 years. So when you adjust for risk, you really do get a picture that's not very pretty for South Africans on their South African equity holdings. It's slightly less the case on fixed income South African bonds, which in a world where bonds yield very little in the developed world, the safest bonds in the world yield very little. South African bonds have been yielding a decent amount and so have been in favor for a while. But that's slightly different now in a post-downgrade world. And we'll have to see how that pans out in the long run. But our risk is almost zero risk portfolio, which is built in pounds here in the UK, in RAND terms, would have given you just shy of 11% return over the last 3 months. So by taking no risk in the global markets and just being in hard currency, one can have an 11% return over the last 3 months, and that return is in excess of 150% over 10 years. So that really is the problem structurally for South Africans with holding too much of their wealth in South African assets.
Thank you so much. Yes, it's a question that I'm getting all the time from EB5 and E2 investors. Everybody wants to wait and see, and I think the danger thereof is because we're living in a volatile economic environment, and taking the factors that you've just highlighted above, it would be to anybody's advantage to spread their risk and possibly have them structured, and contact Sable International to be able to do that. Because once that's happened, it'll shorten the process in terms of, applying for your EB5 or your E2 to transfer the funds. But at the same time, saying so, I'd just like to add that, one can start the process. The process is long. As the process of setting up structures offshore, so is the process when you apply for your EB5 or your E2 or your citizen by investment through First Pathways. So I know you've touched on this. I just want to ask you, so if I had to plan to invest in the US, should I start buying US stocks beforehand?
I wouldn't suggest anyone starts buying US stocks. So if you've got a fixed expenditure that you intend to make in the US in the form of an EB5 investment into a property, and that investment is, say, a year or 18 months down the line, we prefer not to invest client money in the stock market with less than a 2 to 3 year investment time horizon, simply because the stock market has downside risks and we can't foresee those. We can't know when the stock market is going to draw down. So I wouldn't risk capital that is planned for an investment by going into the market to try and achieve, to try and time the upswing just in time to buy the property. I think that's speculative, and that's not good financial planning. What I would recommend is that people not sit around and wait for the right time to move that money from rands into dollars, because we're never going to know where that time is until it's passed. So what they should be planning to do is average out their purchases in rand. So, sit down with your FX broker and agree a phased program over whether it's a month, whether it's a 6-month period, whether it's a year, of how many trades you're going to do rand to US dollar to try and get an averaging of the price. Because there does seem to be a significant amount of South Africans who are waiting for the rand to return to levels that we were at before, 18 to 1 to the pound, for example, those kinds of levels. But we definitely are in a different world now post a downgrade. So that's a very real reality that I think needs to be built into the price, into the future price. And it's simply unknowable what the rand level will be in a year's time, in a month's time, in 6 months' time. So the best one can do is protect yourself a little bit by getting multiple different prices and averaging it out. And if you have a conversation and a structuring conversation with your FX broker, you can get, try and get those phased trades bulked together to improve the deal you get.
Fantastic. Okay, so, and then the last question that I think a lot of investors have asked, particularly on the tax side again, I'm sorry, but I know it's a complex, we could have a whole webinar on that and more. So do expats who've moved abroad need to worry about the Section 10 changes in the Income Tax Act? For example, the taxation of income of South Africans living abroad. I know you've touched on it, but maybe just elaborate if you can.
There is a scenario where one needs to think about it. Firstly, if you've gone to a high tax country, you've got a lot less to worry about, because and that's assuming that country has a double tax treaty with South Africa. So in a high tax country, a lot less to worry about. But the scenario that we have seen that does become worrisome is, for example, we've got a lot of South Africans in Saudi and in Dubai where they're paying no income tax on earnings in those countries, but their life is pretty much in South Africa. So the Section 10 changes do catch that scenario, because that person, in order for Section 10 to be relevant, you have to be tax resident in South Africa in some shape or form. You've got to meet one of the tests. So having the family in South Africa, the children schooled in South Africa, your home, your car, your GP, your dentists, your life is in South Africa, but you live and work abroad and earn there. That is a problematic scenario, and you can even have a scenario where the whole family might be with you abroad, but you have a house in South Africa that is there for your use, or it's rented and your goods are in storage. If you've created a situation that stars can argue South Africa is the place to which you return from your wanderings, then you do probably need to think a little bit about Section 10, about financial immigration, and about how your affairs are set up.
Fantastic. Okay, before I dropped off, there was a question. I don't know whether you've still got it on your screen, Mike, before we go over to Andrew.
I can't see the question, so...
Is that the one about exchange control, Sonia?
Yes, it actually popped up on the screen. If the person that sent a question, and if they could resend it for me, please.
Is this Costa's question about the chances of South African? Yeah.
Yes.
Well, Andy, I think you can have a crack at that one.
Yeah. No, that's a great question. So this has come out of the audience. What are the chances of South African government imposing foreign exchange controls once again? So I think that's probably important just to clarify. I mean, we do have a very strong exchange control environment, although the actual capital controls, which is part of exchange control, has been relaxed. And I spoke about that earlier. But the reality of the situation is quite simply capital controls get implemented by governments to stop capital flight. So at this stage, we haven't seen any mad sort of capital flight from South Africa. We have been downgraded actually by all three ratings agencies in the last month. Moody's took us into sub-investment grade for the first time, and the day of our first day of lockdown, I think it was the 27th of March. A week later, unannounced, Fitch came out and said they're putting us one notch lower. We were already sub-investment grade with them. And then subsequently last week, Standard & Poor also pushed us down another notch further into junk. So it really is going to depend on what happens in terms of South Africa's finances collapsing. At this stage, I don't really see there being a massive run on the rand like the sort of thing. I mean, if you look at when there was that euro crisis in Greece and Cyprus a few years ago, I think it was in 2013, 2014, the Greeks and the Cypriots actually imposed capital controls in the Eurozone, which is a crazy concept when you think that they've got a single currency. And they were restricted as to how much cash they could draw a day because there was a run on the banks. And there was also limits on how much they could actually send out of the country. So I don't think that the South African government will very easily get rid of these allowances that we have. What you must remember, in 2015, we went from 4 million rand a year per taxpayer under the foreign investment allowance up to 10 million. What you might see them do is maybe reduce the 10 million to, say, 5 million or back to 2 million. I think before they cancel any legal outward trade, because politically, if the government was to put a stop on private capital flowing out of the country, I think you would see a stop of capital coming into the country, because it would go back to a perception of a failed state. So hopefully that answers your question, but it's not to say that they don't have the right to certainly reduce the allowances and maybe increase them again at some stage in future. But at the moment, I haven't heard anything, sort of via the grapevine, and we are obviously in talks with a lot of economists, with the banks, and at the moment there's no reason to think that they might stop capital outflows. But if you have got cash available, I would say just avail yourself of your allowances, like Mike said. I've never heard anyone come to me and say, oh, I'm really upset, I moved money out of the country. Long term, it's the right thing to do, is to certainly invest part of your portfolio offshore. So use your allowances.
Right. Andy, what I can possibly do is add some historical context to that question. And that is where, how have capital controls been used in the past? So in the 97, 98 crisis, the Asian crisis, Thailand, South Korea, and Indonesia, all, in order to control the contagion in their countries, had to go to the IMF. And in order to receive the IMF benefits, they had to put in an enormous amount of free market relaxations in their economy, which had various effects. Some people say eventually good, some people say bad. Malaysia took a different route and actually closed down their economy and used capital controls. And there are a lot of economists who think that was probably the better way to deal with the crisis, and that they contained the contagion better. So South Africa probably sees itself in a position as having a lever to pull in a situation of crisis, which is these capital controls. And shifting that number is something they can do very quickly, in terms of closing the gate. So this is another reason why I think for South Africans, it just doesn't make any sense to sit on South African rand assets with a view to investing offshore and waiting for some position on the rand, because these are risks we can never quantify, we can never fully appreciate in advance, but they are there. They are very real risks. So that's why I would say diversify abroad.
Absolutely. Yeah. We've got another question. Sorry, Andy, did you want to add to that?
No. I think that's covered off on that point.
Okay, so Costa sent us another question. Before COVID, the main topic was IMF loan and bailout. And he says, I've heard two economists now hinting that, I'm just trying to follow what he's saying, that straightening the word default, what are your thoughts on an SA default and the government printing money?
Well, I think maybe both Mike and I can probably comment on this, but let me start. I think that, you're quite right. And this conversation is something that's been drowned out by the noise of the COVID crisis. I think if South Africa had to go anywhere to go and restructure its debt, we would probably want it to go to the IMF. I think what we've also got to understand politically is that would be a very politically difficult thing for the ruling party or the government of the day to do, just because of idealistically where they're coming from. The IMF is not really the sort of thing that you'd be happily telling your voters in South Africa that you're going to go and approach for a bailout. But the reality is the IMF are the lender of last resort. They're the deep pockets, and probably, you know, the best commercial terms of that type of restructuring loan. I think in a way the COVID crisis is a blessing, because it's pushed a lot of countries over the edge, and there's no doubt that when you know the dust settles and everybody starts looking at their balance sheets, that South Africa is going to be in a pretty bad space. And I think it's a lot easier politically now for the finance ministry and for the treasury to go and approach the IMF under the guise of COVID being a good excuse. So I think my sort of view, quite frankly, is that yes, South Africa could easily default. I mean, the reality is, after this, what is our tax collections going to look like? Our cost of borrowing has gone up quite a lot since all the downgrades. So, you know, the government is going to have to find a lot of cost savings, which are going to be politically difficult. They've got to cut the government services wage bill, which politically has proven extremely difficult to do. Look at SAA, how long that's taking to die a death. So if we do default, that becomes messy. I think the IMF is definitely going to be somebody we're going to be talking to.
Thank you. I hope that answers your question, Costa. You're more than welcome to email us. You can email me. My email details are on the website, and we can most certainly put you in touch directly with Mike and Andrew. Talking about the South African government bonds now being excluded from the MSCI World Bond Index, what effects will it have on the RAND?
Sonia, that's an interesting question. I mean, for the last 2 or 3 years, we've all been standing up at various conferences and talking about what this sort of last sort of nail in the coffin when Moody's puts us into junk finally. The ruling, as everybody sort of understands it, that is if all 3 ratings agencies have you rated on your sovereign debt as junk or sub-investment grade, that we are no longer allowed to participate in the MSCI World Government Bond Index. So that means that anywhere between 10 billion US dollars, which is now about 17 billion Rand, could leave the markets. But what has actually happened with this downgrade is that hasn't happened in one fell swoop. So those investors and those fund managers who've got money sitting in the bond market that are now on the wrong side of the guidelines, a lot of them have already moved the money out. There's been a mass sell-off of South African government bonds by foreign investors over the last 3 or 4 months. So I think that the South African bond prices were adjusted before the downgrade. Our cost of borrowing was already very high for a country that was still investment grade with one of the agencies. But I think that we're going to see, after the dust settles with the corona crisis, is that the Rand will be structurally at a new lower level. So that 7 to 8% trend line that I was talking about earlier, I think we're probably going to see a bigger drop, and then we'll probably track along those sort of percentages again, you know, in an equal world going forward. But the Rand will never come back, I don't believe, to pre-downgrade rates. I really can't see it happening, especially with all the other sort of negative effects that are happening. So yeah, that is a very Rand negative thing, this government bond index. It's just our cost of borrowing has gone up. Yeah.
Very sad, very sad. Right, one final question before I close up. Anybody else got any questions? They're welcome to send them in the chat box. The last question, we've seen 2 interest rate drops in the past few weeks. What impact can we expect here on the Rand? I know we've touched on it, but maybe elaborate a bit.
Well, I think if you remember back to the global financial crisis in 2008, some of you may remember, if you had any mortgages or any bonds on your properties, very shortly after the crisis, the government put interest rates up quite aggressively here. And suddenly we were back into sort of double-digit interest rates. What the government was trying to do then was, by putting up interest rates, is to make the rand very attractive to yield-seeking investors. So to attract market money into the country, which would take the pressure off the rand. But what has happened now with the COVID crisis is that, in line with all the central banks, the South African Reserve Bank, we've actually reduced the interest rate substantially in the last couple of weeks. So whilst that's good for local consumers, and it actually puts a lot more cash into the economy, because suddenly people are paying less interest every month on their bonds and their motor car repayments, etc. It is not very good for the rand, because the interest rates are dropping, so the yield for foreign investors is dropping, and then they're turning around and they're having a look and saying, okay, well, interest rates have come down, the risks are really high, is it worth sitting in rands at the moment? So we've also got to understand that interest rates globally have dropped, but the problem is that the marginal drops in the US, the UK, the EU are very low, because those interest rates were probably all sitting around about 1% before the crisis, whereas we've actually had a 2 percentage point drop. So that's relatively a big drop. And I think if we saw interest rates going up a lot, we'd see a lot more foreign cash coming into the market because of the yield. So I think, just in a simple answer, that those decreases are great for us internally, but not good for foreign investment.
Right, thank you. I think that wraps up today's discussion. What I would like to say to everybody on the webinar today, the whole reason that we're having this discussion is whether you should be investing or divesting, as per my last webinar we had. And just to say that whether you want to live or work in the US or immigrate to the US, we do have the products to accommodate you in terms of your investment portfolios, whether it be an EB5, whether it be just a second passport, citizenship by investment, or whether it would be then that citizenship by investment through a treaty country will then gain access into the United States into the same project, whereas you actually physically own the project, 50% of it. It's a business. It's called Teriyaki Madness. It's very popular. It's a brilliant product that we've got in terms of EB5. Let me know when you're available. You can call me anytime, drop me a WhatsApp. And in terms of getting yourselves ready in terms of your investment or immigration goals, please give us a ring, drop us an email, and we'd gladly work together with Sable International to assist all our clients. I think that, in closing, that is about it. I think we've chatted extensively. I think there are going to be more topics we can touch on. If any of you would like to know more, we would be happy to host another webinar. And we look forward to hearing from all of you. Thank you so much, Mike. Thank you so much, Andy. Appreciate you all.
Thanks, Sonia.
Yeah, thank you, Sonia. Thank you, everyone, for listening. It was enjoyable.
Thank you.